Good morning and welcome to today's webcast, Transfer Pricing in India, Opportunities in the New Landscape. A few reminders before we get started today. You may customize your webcast view. Feel free to rearrange the windows as you would like, and you can also resize them by clicking in the lower right corner and dragging. If you have any questions for our presenters today, you may submit them in the Q&A window beneath the slide view. Finally, you may download a copy of today's presentation in the slide deck and handouts widget to the left of the slide view. If you're unable to download this at the moment, we will be sending it via email after the webcast. And with that, I'll turn it over to Chris to get us started.
Thank you, Emily. First of all, I'd like to welcome all our participants today. It's our pleasure to have you with us as we go through our topics on transfer pricing in India, the opportunities and the new landscape. We've been working with ASA Associates on a number of items, and it seemed to us that this topic was of broad interest. So it is truly our pleasure to bring it to you today. I'm going to go ahead and introduce our speakers. First of all, I'm going to start with Sunil. Sunil Arora is the head of tax in the Mumbai office with ASA Associates. ASA is a top 10 Indian chartered accountancy firm. They have 8 offices, and they really specialize in international taxes, and including specific desks for the United States, Japan, Germany, and France. As I mentioned earlier, Sunil is the head of tax in Mumbai. He specializes in international tax with a concentration in transfer pricing planning and dispute resolution. Our other speaker today is Darren Lowe, head of transfer pricing at Moss Adams. Moss Adams is the largest West Coast-based accounting firm in the United States with more than 3,000 employees. And we have specialized desks for emerging markets, including China, Brazil, and India. Darren is located in our Silicon Valley office with a particular focus in transfer pricing in the technology space. So he's our IP guy. And Darren's primarily spends his time assisting clients with designing and implementing transfer pricing strategies. For those of you who don't know me, I'm Christine Ballard. I'm one of the international tax partners at Moss Adams. Kind of all duties as assigned, as the transfer pricing, some of the global mobility, and then the core international all feed up to me at some level. My background really is in U.S. corporate, and I'm here to facilitate today's presentation. Today we're going to cover a couple of different topics. To really get it kicked off, the global transfer pricing landscape over the last couple of years has really undergone a dramatic change. And the tax authorities now expect integrated transfer pricing approaches. Today we're going to be reviewing the environment in India particularly and how it impacts U.S. multinationals. So we're going to start with painting the picture, the landscape in India, what the U.S. view is going to be of that, how to protect ourselves and understand the dispute process. And then finally, we're going to touch briefly on BEPS, which sort of was the catalyst for all the changes we're going to be talking about and that are ongoing at this point in time. And with that, I'm going to go ahead and turn this over to Sunil, who's going to start today's discussion by providing an overview of the Indian environment. Sunil, I'm going to turn over the control of the presentation to you at this point.
Thank you, Chris. Thank you so much. Good morning, everyone. The way I've arranged my presentation today for you is really to give you, as Chris said, a flavor of the Indian landscape, how we have evolved over years. You see in the slide before you, we talk about how the law was introduced way back in 2001, 16, 17 years ago. I still remember my first case. And today we are in 2018. A lot has changed, a lot hasn't. A lot of things still to do. We basically started in 2001. Financial year in India, we work on a financial year basis. 2001-2 was the first year of assessment for us. And I will keep using these words, assessments and audit, TP audit interchangeably. The way the law was introduced at that point in time, we weren't very clear because we came out with a particular set of legal provisions, but we did not do very well. In terms of setting a landscape for the way we are going to practice transfer pricing in India. So there was this law on one side, and there was this set of very brief guidelines, and that's where the entire story went through a very rough patch in the beginning. So 2001 we started, and until the next roughly about 10 years, it was very difficult to manage. I think the basic criteria or the basic set of officers who took over the charge on doing transfer pricing at that point in time were simple revenue officers, educated set of officers, but straightforward officers. They knew transfer pricing as a simple legislation in India, very briefly talking about a non-resident getting taxed in India. So they didn't have a clue of what's happening on a global platform. So, the legacy of their thought process carried on to the way they made initial assessments. So it was a complete mess out there. The assessments, the conclusions which were drawn in the initial years were extremely high-pitched. There was no regard to comparability norms. There was no regard to methods to be adopted, no regard to the adjustments need to be done, reporting norms, disclosures, no, nothing. Simple cases such as, or straightforward cases such as back office services or ITES services, they did not understand what the business was. For them, every ITES business was equivalent to an Infosys in India or to a Satyam, Mindtree, Accenture. They did not know the difference. So we went through a very rough platform. What they also did was, with a specific mindset of enhancing revenues for the Indian government, they simply, when they started comparing you with other companies, they simply picked up companies which were high profit making without any demarcation of whether or how the industry would behave as a whole. So we were in a difficult phase. Typical issues like R&D companies. R&D companies in the pharma sector were compared with R&D activities in the automobile sector, for example. So we were completely taking a different path. The approach was very arbitrary, very harsh. We didn't know what we were doing. Come 2009, we felt the need that there has to be a specific authority dealing with, as a first levels of appeals, there has to be a specific authority dealing with transfer pricing cases. There were too many piling up at that stage. And at that stage in 2009, we introduced something called a dispute resolution panel. Now, this was a panel of 3 senior tax officers. Again, they could only gather as much experience, as much as they did in their as the role of a transfer pricing officer, but they still, made it happen. It was again a rough start since the objective of the dispute resolution panel was not very clear whether they wanted to decide on legal issues or factual issues, whether they wanted to look at issues of characterization, nothing. And therefore, it was a very rough start then. Come 2012, we proudly and with a lot of fanfare, we introduced advanced pricing agreements. I'm going to talk more in detail about APAs in the later part of the presentation. APAs was an immediate success, immediate hit, because we could sign one APA in year 1. So people were very happy. It was going hunky-dory at that stage. 2013, we introduced Safe Harbor. As most of you would know, Safe Harbor provides you a particular platform. If you fall within that particular platform, you are not exposing yourself to transfer pricing litigation. Now, this initial phase of Safe Harbor was a complete failure from the word go, for the simple reason that the scope of the Safe Harbor was very, very limited and the rates proposed were very high. As a matter of fact, some rates for the specifically technology companies engaged into a contract R&D, which Darren is going to cover later in the later part, was as high as cost plus 30%. Pharma companies cost plus 29%. So it was certainly not something which we wanted to do. 2015, some improvements made. We were trying to ape OECD as we grew in the process. 2016, we again were trying to ape what OECD was trying to do under the BEPS program, BEPS being the catalyst of this entire change. 2017, a lot many options available to go this way or that way. Litigation is still something which is on a very large scale, and I'm going to discuss the litigation part with you also. We came out with thin cap rules, we introduced secondary adjustment. Anything and everything we did was in line with the BEPS program. Next slide, something, experience-based observations, how we performed in the last 15 years. Now, the transfer pricing guidelines in India are largely based on OECD platform. India does not explicitly recognize OECD. We are neither members of OECD, but we still follow the OECD practices. BEPS is an outcome of the OECD discussion papers, and there we are trying to follow BEPS. What is critical is that even though we don't follow the OECD norms, we don't really, we are not formally required to follow OECD norms. The taxpayers, the revenue bodies, and even the courts give due respect to the OECD guidelines, and therefore very critical to understand where are we on the OECD platform on a practical side. Till now, we have a quantum-based documentation requirement. Quantum-based documentation requirement, the thresholds are very, very low. They are as low as $150,000 US, certainly not very practical in today's world. The penalties and the action against the taxpayers for not fulfilling these compliant requirements or not maintaining a transfer pricing documentation, and there is a lot more to it, are very stringent. So something like a 2% to 4% of transaction value could be your penalties if you are not really in line with, if your documentation is not in line with what they expect it to be. Transactions like share capital, if you infuse share capital in your Indian subsidiary, that is also for the purposes of counting the threshold or looking at the threshold, is a part of an international transaction subject to transfer pricing. Availability of comparable information is still a major challenge. As you know, in India, the reporting, especially in the private sector, is not very strong. We follow IFRS, but selectively. The policies are uniform, but the disclosures are not too many for us to draw a common size statement of the comparables I am supposed to compare myself with. The databases are very limited. There are just 3 or 4 databases which we're relying on. And mind you, none of these databases is authenticated by the tax authorities till date. We use something to do general comparison. We do something to do foreign company comparison, something else for royalty comparisons, so on and so forth. There is no restriction on use of secret comparables. That's a very critical part again. In one of our cases, there were 2 companies, neighbors to each other, and one company was being assessed by under the tax audit. The tax officer simply asked the neighbor company who was into similar business line to submit its financials and try to make a comparison there. So we could go to even that extent. We have been fulfilling our commitments under BEPS. There are additional requirements of submitting master files and country-by-country report. I'm going to discuss more about it in the later part of the presentation. The audit process is still very aggressive, now in the 15th year. Aggressive in the sense that initially for the first 10 years, as I had mentioned, in the first 10 years, we didn't know what we were doing. It was a very, very rough patch. The growth was very slow, very sluggish. However, in the recent phase, in the last 5 years or so, the tax officers have shown some sanity in the way they deal with transfer pricing issues. They are taking into account business considerations. They are, being guided. They are being looked at, supervised by the senior tax officers, so on and so forth. So we are making a lot more sense of what we were doing earlier as compared to what we were doing earlier, but we have a long way to go. As I said, safe harbor is one option, advanced pricing options another option. If you look at safe harbor, I'm going to discuss more about it later. Safe harbor still has a long way to go. There are the options under the safe harbor are still very limited. They only address very basic issues such as ITES companies, contract R&D cases, KPO or auto components, but not very many. APAs, similarly, APAs are gaining pace, and we're going to have a more detailed discussion on APAs later, but it's still out of reach for most for various reasons. To begin with, India has signed about 232 APAs till date. Good, bad, ugly, I don't know, but we have a path to follow. Non-resident taxpayers are also subject to TP transfer pricing compliances in India, even though you don't have an entity in India, but you are subject to taxation in India. That's where, even in those cases, you are subject to fulfill or meet transfer pricing compliances in India. The dispute resolution mechanism is robust. Whether it's adequate or not, we got to see that. Now, in terms of the dispute resolution mechanism, there are multiple options which we have on the table. Options provided by the revenue authorities, options provided by the law authorities. Courts in specific are generally have taken a benevolent view towards the taxpayers, and we're going to discuss more on the dispute resolution panel later. As I said, the tax assessments initially have been high-pitched, and the numbers are humongous, numerous numbers. Transfer pricing, as we stand today, transfer pricing is the single largest cause for all tax disputes in India. Look at some numbers here. So, of the cases selected for TP audits, 50%, mind you, 50% face TP adjustment. Now, the good part now is that not very many cases are picked for TP audits. Of the total cases selected for audit, about, again, 45 to 50% relate to IT and ITES segments. So very critical for you because you are the easiest, you are the softer target for the tax authorities. Disputed cases, again, that's the good part. Disputed cases decided in favor of taxpayers is almost 70%, which is a good success rate, but again, it comes at a price and after a certain time period. Most of the disputes relate to the issues where you have to select your appropriate comparables. Again, this is not something which should be happening at this stage, but we're still fighting with some basic issues. And again, the bigger cities have, bigger the city, bigger the dispute. So Delhi, Mumbai, and Bangalore, three main cities, account for almost 70% of the total dispute, in India. So litigation is a reality. It's prolonged, but this government has taken some very efficient steps in taking care, supervising the tax officers very effectively, very closely. So we are quite hopeful that going forward, it's going to improve. In fact, there were cases where the tax officer were given specific guidance that you're not going to touch cases which are low risk or which are not going to, or which have no precedence of any tax adjustments in the past. So we are looking ahead in a very positive manner. Now, what are the main areas or which are the soft targets or the known triggers here? Now, if you were to look at the category of cases which are the soft targets, the real soft targets, and there are very many, but the real soft targets are companies which are loss-making companies, typically manufacturing companies which require a larger gestation period to break even. These are the softer targets because they are making huge losses in the beginning. Companies which are capital intensive, or wherever you have a precedence of a TP adjustment, a transfer pricing adjustment. There was a 2016 circular by the apex body which said that you got to contain these cases because there were a lot of cases which were going to TP audits, and they said try to be more realistic, try to be more risk-based in your assessments, and therefore they gave out some very clear guidelines. Business, cases involving business restructuring. The attempt of the revenue authorities is to understand whether the restructuring leads to tax avoidance or it's a genuine restructuring. And then there are very many cases like this. The real takeaway is that you've got to be prepared with your documentation, and as we go forward, you will realize that that's the key in all the cases we discuss. Over to you, Chris.
Thank you, Sunil. One of the things I've learned that's quite different between the approach in the United States and the approach in India. In the United States, we have different levels of field audit appeals and then potentially courts beyond that. And most of the issues are settled either in the first or second levels and don't get past appeals. In India, the landscape is quite different. There's almost a presumption that if there is a transfer pricing adjustment proposed, that there will be litigation involved with that. It's just a very different mindset. Darren, with Sunil's background on the landscape in India, can you now walk us through what the IRS and US-based companies will need to focus on with respect to their Indian operations?
Certainly. So now I'll just focus on some of the things that U.S. companies face in India, and I think there's a lot of opportunity, and companies have had a great success, and just the landscape is trying to understand some of the pitfalls and the things to be wary of. So the issues that are particularly that we typically see is intergroup services. So this is in the case where you have the Indian entity provide sort of back office service or some sort of centralized services for the U.S. company or vice versa. One of the key points here is there has to be kind of the actual receipt of services and also the invoicing and the payment. And as many folks out there, 267D, where you need to actually make the payment in order for it to be deductible. There's the question of the cost versus the benefit, and making sure that that it's a valuable service, and documenting those services is also very key. We'll talk about that later in this presentation. Contract services, again, if there's any sort of type of services that take place, in particular, we later on talk about IT services, there's contract R&D, there's also, kind of now these days, cloud services. The question around this is the kind of the arm's length price that's associated with the functions and risks assumed. Contract services between companies is always, is going to be a big matter. Here's the most common here, particularly in my area, in Silicon Valley, the contract R&D. There's a whole lot of cloudiness around what are the rates, particularly with contract R&D. We've seen safe harbor rates, as Sunil mentioned, like 30%, but we are seeing some of those rates now coming down slightly because, India has been outside of what the typical realm of contract R&D is in, say, US, Europe, and Asia. And then the second point we have on that box there is the safe harbor rates and how they are whether they're consistent. And yes, they are, high, but at the same time, they are coming down. And then the fourth matter we have here is life science companies. Obviously, there is a very technical workforce in India, and there's a lot of opportunity. But at the same time, the tax authority over there in India is really looking at the type of the intangibles that are being created, and if there is kind of a shared resource that is being created in that jurisdiction. So, the Indian authority is now looking towards more like a profit split, but life science companies are all facing sort of challenges in the market also. Moving on to the next slide here, we're looking at kind of a scenario where, if there are intergroup services between entities, what's some of the things that the Indian authority will look at. So, as I understand, India does not have any specific guidelines for the determination of intergroup services. However, they do lean on, like many countries, the OECD guidelines, the United States, TP regulations, and they will also look at, the court cases that have been recently coming out. And most recently, we've seen some interesting developments here in the US on Arora, on stock options. So really, some of the things to be cognizant here is defining the character of intergroup services. and making sure there's a benefit, and it's making sure that there is no duplicative services. The application of a method in order to determine those services, and also documentation around those particular items that are being provided. Moving along on the next slide, some of the things what the IRA expects in India, it's very similar to what the IRS also expects. We have the question of why a related party and why would you pay a related party instead of a third party, and that's really got to do with kind of the pricing. Why, if, for example, you may have a third party who could provide the service much cheaper. The nature of services and the need, again, this is kind of the question around duplicative services. Why would you pay a related party to do the same thing that you already undertaken? Is there a real need or real benefit? And then Sunil, maybe you can talk about the need for monetization here on this third point here. It's something kind of interesting.
Yeah, absolutely. Darren, I think the real issue here is that when you receive these services and when you pay for these services, the basic question which they ask is that, you are the shareholder. And to us, these services appear to be shareholding services. So what is so specific about these services that they need to be monetized? These are simple shareholder services. You're trying to protect your interests, and therefore, why pay?
Right, exactly. And then we've got some of the other questions around, what are the margins and what's the basis of the pricing? So then it's what's included in that cost base. And some of the, obviously, is it beneficial to the entity itself? Moving right along here, on the contract services provider side, we have 3 items here, which is the IT or IT-enabled services or knowledge process outsourcing. Some of the key points here is the classification, and we see this come up a fair bit here in the Silicon Valley market, and I guess with any sort of client, is the classification of the actual service in itself. And, I've seen with clients that they may call something R&D. I had a client that was performing customization for their electrical equipment, and they called that R&D. So then obviously that is a different level of R&D as to would say, pharmaceutical research, for example. So I think one of the key points here is making sure that you document and you classify your, IT services. They could be low end, they could be really just customization of websites, or they could be high end, technical type of work. Moving on to the right of the box here, there's comparability challenges. As Sunil mentioned, they have a database, and we have this issue across, transfer pricing always is the constant trying to find publicly available comparables for the type of processes that you're taking place. Often there is not sufficient data, either financial data or not enough data around what type of activities the companies do undertake. So that's always a challenge. But we've seen some of the denial of adjustments. So in the US regulations, there is an opportunity to undertake working capital adjustments. Unfortunately, the Indian authority does not accept those, and that's something to be mindful of. Yeah,
and that is just to add a point here. The authorities, the courts, given the complete lack of guidelines here, the courts have now started giving you relief on the working capital adjustments, and specific to companies where capacity is an issue, capacity-related adjustments also. So it's evolving here as well.
Right. And I guess on the thanks, Neil. And then on the fourth box there, we had aggressive cost plus markups, and as many folks have seen, there's a range of markups between 28 to 45%. But again, we're seeing that coming down, in line with kind of other countries, but it still tends to be on the higher side. Moving right along on the next slide, contract R&D, and this is the huge one, particularly for Silicon Valley companies, or any company that does kind of R&D. R&D has always been a great opportunity for many companies to, at a lower cost, highly technical workforce in India. So that it has been, obviously a lot of cost savings, but at the same time, we're seeing the Indian authorities, seeing these cost savings and therefore expecting a higher markup for those type of services. And it's typically been a cost plus. So, based on the global perspective, we've always seen emphasis on the functions, assets, and risks, and then determining who is the actual owner of the IP, and then who is the undertaker of the actual technical work. But now, moving to the kind of the broader view in the world now, especially with BEPS, which we'll cover later on, is now the concept of R&D. They're looking at it more like, well, if you're doing something locally, there may be some sort of local intangible that you're creating, and that's where documentation comes very key, because they're actually now looking, instead of a cost plus model, they're more looking at a profit split, and jurisdictions, not just India, but countries in Europe are looking at sort of a fair share of the profit or the the type of activity, kind of the sharing of the IP that's taking place. So that's kind of now it's a changing world where we look at one side, but now they're kind of more looking at holistically at kind of the overall activity itself. Moving on to the next slide here on the contract R&D, what the IRA expects. They've got the same view that there are valuable and unique IP being generated in the local market, and there may be cases where there's IP that's being developed by the people who undertake the work. So, and then if there's not a contract in place, there is an opportunity by the authorities to say that there is actually transferred IP from India to any other country, or particularly the US. So that's always something to be cognizant of, and we always advise our clients to make sure you have a agreement in place to make the lines very clear that if you are undertaking contract R&D in India, make sure that you have something that says that the work is on behalf of the US company. Now, that's some of the safeguards is obviously documentation. It's always key to make sure that you have adequate documentation. You also aligned your communications in terms of what you're doing, particularly the activities. And we had touched on earlier kind of the high-level IT services and the low-level IT services. Make sure that's very clear as to what you do, and the description is very detailed, because the more detailed, the better. And I guess the more proactive you are in documenting your activities, it's always good to keep that on file. And also following sort of the CBDT circular on R&D, which gives you guidance on the particular items there. For life science companies, we had kind of various points here. I see the Indian authority looking at the import price of active pharmaceutical ingredients with the price of generic, active pharmaceutical ingredients. That's kind of key. And it seems like they're looking at the kind of a cup analysis to seeing where kind of the cost of the generic drugs, and then looking at the branded drugs, and that kind of looking at the IP that's being generated from a brand perspective. Interestingly, the Indian authority is looking at custom databases now, and the harmonization between customs and transfer pricing is happening, more and more often now, because people, companies have a different value for customs that they'd have for transfer pricing on the book. So, obviously, for transfer pricing, often they want a lower price, but whereas customs want a higher price because it's they collect more duties. So again, life science companies have difficulty in identifying appropriate comparable companies, and it's always a challenge to find something that exactly what a client is doing. There's also the focus on losses. If there is a particular drug that's entered into the market and it's trying to develop a greater expansion, whether the new product launch is creating losses, that's kind of interesting. Whether it's how long those losses will be for. They're looking at the kind of the product, each product profitability. So now in detail, not just, the cost of goods sold, they're looking in particular items within that, so more details as around what the markups and margins are is always key. And we're also, the sixth point that we have on the bottom right-hand box there is the third-party costs are not being, denied as a pass-through. So I guess they're expecting more margins in that area as well. So some of the safeguards, particularly for life science companies, is make sure that you have a reasonable result. To have a reasonable result, look at setting your price and then supporting it. The next is having robust documentation, as always. I think it's always key throughout the year to have some sort of adequate documentation, and also making sure that you keep or documentation around your functions, assets, and risks, particularly in each jurisdiction. Again, harmonizing the customs positions and the selection of comparables, making sure that you have comparables to the transaction that's taking place. And then, obviously, the alignment of transfer pricing in the public and and documents in your website. So making sure that all the information that's out in the public is kind of consistent internally and externally. And with that, I'll turn it over back to Sunil to talk about some of the areas of dispute resolution and safe harbors and APAs.
Yeah, this is Chris. I'm going to break in here for a moment. We are running a little bit behind, so I'd ask you guys, you gentlemen, to please keep our timing in mind as you move through the next couple of slides. I do think the dispute resolution, safe harbor, and APA discussion is important because this is what our listeners can do to protect themselves. So Sunil, it's now your presentation.
Sure. This is what a dispute resolution mechanism looks like in India. So you either have an option to opt for a routine dispute resolution mechanism, or you could go under the advanced route. Now, routine dispute mechanism essentially is split into two parts. One is, contesting the matter and appealing the matter within the realms of IRA. And then the second step is to go to the law authorities and try to argue your matter at the tribunals, or if you have legal issues, you can go further up the ladder and try to argue your cases at the courts. So the chart which you see here, basically it starts from the transfer pricing officer. He takes about, from the end of the year, he takes about 2 to 3 years. You go to the first appeals. It could either be a dispute resolution panel, I spoke about it earlier, or a commissioner of tax appeals, which again, DRP, dispute resolution panel, is a time-bound mechanism. Takes almost about less than 12 months to conclude a matter. But the commissioner appeals, it's a single body authority, and therefore could take more time. And then you move on to the tribunals. Now, effectively, tribunals, it's an entire chain. Tribunals are a body which really takes cognizance, or which takes note of the legal and factual matters in an exhaustive manner. Now, the good part is that the tribunal is not a part of the IRA authorities, and therefore you expect, when you go to the tribunal, you expect a realistic, practical, and fair decision. That really should be the takeaway when you talk about the routine dispute resolution mechanism. Jump to the advanced mechanism. You basically have two options. One is a safe harbor option. You could opt for a safe harbor before filing your tax returns, or you could look at an advanced pricing agreement. I'm going to talk more about it later. Now, basically, if you were to draw parallels, and in terms of time consumed, what the amount of certainty which you get, and what are the other matters that you have to deal, what clearly comes out, what clearly emerges, is that under the routine dispute mechanism route, you are really looking at, if you have a dispute with the tax authorities, you are really looking at a safe period of 8 to 10 years by the time the matter gets decided by the tribunal, at the tribunal stage. expect a good response. I already told you that 70% of the cases are decided in your favor, but it's a patience game. It's really a game which you have to play for a long time. Cut to the advanced dispute resolution mechanism. You are really looking at a maximum of 7 months if you go under the safe harbor route, and 2 to 3 years for an APA to mature. Typically, in India, we have taken up to 4 years for an APA to mature, but 2 to 3 years is the timeline we look at, typically, and therefore, so the comparison is very clear. In terms of certainty, under the routine dispute resolution mechanism, under the first option, even if you get a favorable decision for 1 year, it will not get automatically applied to future years of dispute. So you have a problem. The tax officer is not the same every year, and therefore he might have a different approach to your case next year, and therefore you are really, the success is not a real success which can be copied to other years. Under the advanced dispute resolution mechanism, this is completely different. You sign a safe harbor, you're safe for 3 years. You sign an APA, you are safe for up to 9 years. Typically, the companies will use this leverage for between 5 to 7 years, but 9 years is the maximum you could go. In terms of other compliances, under the routine mechanism, you will still have to do year-on-year routine compliances. Under the advanced mechanism, it's really something which you have done at one stage, and in the future years, you just have to do a very minimal level of compliance, which means that your burden is reduced to a great extent. Now, this is a broad overview of what we cover under the safe harbor rules. I told you the safe harbor rules were rationalized 2 years ago. So the rates which were 30% on the contract R&D have come down to 24%. The rates which were really on the ITES services, IT and ITES services, 21, 22 have come down to 17 to 18%. Still not really at the levels where the IRS would expect, but still at a level where you could have a consensus. Darren, what is the view of the IRS there?
Yeah, sure, Sunil. Thanks. Yeah, this is some issue, in talking with my contacts at the IRS, there's a dedicated team actually to these type of issues. And as you said, the rates are coming down. So originally they were like 30%, and now we're seeing closer down to 20%. One of the things I did have a question to the the leader of the transfer pricing at IRS, and he had mentioned that if you do take the safe harbor, you'd actually limit yourself to IRS correlative relief. So it does, it does limit a taxpayer if the safe harbor is taken. So that's something to consider if you do choose that route. I think there's a push now for kind of a bilateral APA, and again, the dedicated team towards India issues. They meet every 6 months to run through cases, so they're trying to get these through quicker. Turn it to you, Sunil.
Sure. Coming on to the APA program, how did APA evolve in India? I said, somewhere in 2012, we felt the need for an APA. We are following, the OECD. The BEPS plan says that every country should have a fair way of alternate dispute resolution mechanism. So what does a typical APA involve? It involves an open negotiation with the Central Board of Direct Taxes, which is the IRA's representatives for the APA mechanism. Now, as Darren said, APAs could be unilateral, bilateral. A conversion is permitted. Although we have seen that wherever an APA is introduced, the initial push is towards unilateral, but gradually it evolves into a bilateral situation. And as Darren said, that's more or less happening. That's really the push from the IRS's side also. Now, an APA under the Indian program can be valid up to 5 consecutive years with a provision for rollback up to 4 years. So in an ideal year, in an ideal case, you could cover as long as 9 years in the entire process, which can be very beneficial. Now, what's typical to Indian APA is that you have an optional preliminary discussions platform available. This pre-consulting is possible on a no-name basis. And so if you were to approach the IRA here and try to get, you want a spiel of what your case is going to look like in the final APA, you could go there, discuss your case openly, submit documents, have a mock discussion with them, come back and still decide whether to go forward or not. This is a very, very useful step, and it's optional. You can choose to go for it or not. You are allowed to withdraw it. You can amend your APA in between until the time it is signed. You can revise it. You can renew it after the expiry. That's absolutely possible. Now, the good part about APA is you're sitting in a meeting room with some educated set of officers, with third-party experts who are willing to discuss these options with you, taking into consideration economic parameters, commercial parameters. It's really an open discussion room. It's like a corporate discussion. And that's where your past history of your disputes will not have a bearing on any APA negotiation. So we have had clients who have had disputes for 1 or 2 years, and then they chose for an APA option, and whatever had happened in the past did not matter, and they were able to get relief on pending litigations because the rollback did impact them, and of course the future years. It was a win-win situation. Now, that's how the process looks like. I've already spoken about the prelim phase. You have an option to take a step forward, to do a mock discussion, get a feel of the entire situation, get a feel of your chances, take a step back or take a step forward. It's completely on you. If you take a step forward, you will formally move an application for an APA, and that's how the process starts. You get into negotiations, and eventually you agree, you negotiate, you sign an agreement, and then the post-agreement compliances come into play. Now, APA for us has been rather successful. We have signed maximum applications with USA. Of the 127 applications signed, we have signed 42 with the US. Now look at the statistics going further. The service sector dominates the APA regime. There have been significant increase, and there have been very many APAs which have used the rollback option. And as I've told you, we are going step by step. So it starts from a unilateral kind of a discussion, goes into a bilateral regime very shortly. Now we are seeing more of bilateral, as Darren said. That's really something which we should expect going forward. Now this is an overview of what kind of services are covered, discussed under a typical APA. So you have typically KPO services, R&D services, contract R&D, intra-group services, IT-enabled services, software development services. They have not left anything. I think almost all the services relevant to this discussion are being covered under active APA discussions. Now, what are the key considerations here? Now, the program has been largely successful. APA conclusion rate of 152 APAs in 4 years is considered satisfactory. Compare ourselves to China. China did 113 APAs in a period of 10 years. So we are really moving forward at a good pace. As I said, it's an objective process. You have third-party experts. You have an educated set of officers, revenue officers, IRA officers, but with a completely different mindset. It was difficult at the beginning to look for those officers, but they have arrived. They really have a knack of discussing in a more corporate manner. Now, as I said, a preliminary discussion is a win-win for everybody, and there have been very many clients who have chosen to not go to an APA, having experimented, having tested waters at the prelim stage. On an average, of the every 3 applications moved for a prelim assessment, 1 generally would go forward. Now, we have got these are closed room discussions, so we will never know what the conclusion was. But we are in a consultant fraternity, and we come to know what happens, and you keep talking to the officers, and you get a feel. So, in terms of the conclusions, we have been told that agreed cost plus margins for ITES services in APAs have ranged between 16 to 18%, cost plus 16 to 18%. Similarly, contract R&D has been hovering between 18 to 20%, 22%. Now that's still not at a desirable level from perhaps the US IRS perspective, but quite a good progress. Now, it's an expensive process. The costs are as high or perhaps slightly lower or equivalent to the costs in the US. But given that the benefit, you are able to spread the benefit over 9 years, whenever you look at the cost plus benefit, split it over 9 years, and then you will get a clear decision on whether to go for it or not. It's expensive, but of course, the 9-year thing makes it a viable proposition. What do you say, Darren? Anything to add here on the APA part from an IRS perspective?
Yeah, I think that's great, Sunil. On the Indian side, I have seen a lot of cases. The only difference I see is that in the IRS, we have an opportunity for small taxpayer. I'm not sure if you have something similar, but we have...
Not yet.
Yeah, we have an opportunity for small taxpayers to undertake APAs, which I believe is quite a fast track, and it's less than 1 year. So they actually do have a streamlined process.
Excellent. Okay.
Well, thanks, guys. I'm going to go ahead and advance to our next topic, experience-based advice. So hang on a second. Let me get to the right slide. I do think it was interesting how the results on the Indian APAs is then putting pressure on the safe harbor rates, and it's probably contributing to the fact that safe harbor rates are coming down. And I think for our listeners, one of the other key points from the last topic is the ability to, on a no-name basis, do a preliminary assessment. So get your transfer pricing documentation together, go to the Indian authorities, get that preliminary read if they're, thumbs up, thumbs down on your plan, and at that point reassess whether you want to continue through the APA process, withdraw, and then are there things you can leverage from that preliminary assessment that you can then implement without moving forward. So it may be a way to kind of test the waters, see where you're going, make some adjustments, and then move on as an option. So Darren, I'm going to go ahead and turn this over to you to talk about safeguarding the interests, because I know most of the folks on the webcast are our U.S. clients. So please tell us what our clients and our U.S. multinationals can do to safeguard their interests.
Certainly. So I think on this next slide here, TP transfer pricing is not just a year-end process. It's throughout the year, making sure it's contemporaneous, and be proactive. It's always be to get ahead of the curve, and always tell clients that making an entry towards the end of the year. Or in December sometime is always tricky from an order perspective too, because they see large amounts of transactions going through.
Same here.
It's always key to do that. Always look at all the commercial and legal options that you have. I think especially from my point of view is having an agreement in place. That's kind of one of the key things that any tax authority should request during sort of a review or an audit. Make sure that your TP policy is realistic and it's practical, and that it incorporates all aspects of the business, not just simply for tax reasons, but also it's consistent with how the business operates. Always make sure that it's not one-sided, because there's transfer pricing exposure on both sides, and now in the world of BEPS, which we'll cover later on, it's both sides, and it's both all countries. There is exposure on both sides. Transfer pricing is tax authorities. It's a high return on investment for tax authorities, because transfer pricing audits and reviews yield a lot of tax dollars. So they have dedicated a lot of resources. And the growth of transfer pricing over the past 10 to 15 years has been exceptional. It's really grown from being predominantly in the high tax jurisdictions, and now you could say it's effectively around the world. So that there's a lot of time and resources put towards it. Obviously, ensure the time and accurate compliance with all the tax forms. I understand India, you need to submit documentation now for transaction. As Sunil mentioned, kind of a low threshold of $150,000 US. So make sure that you have those forms taken care of. And TP documentation more and more is a reality, and having something in place is always key to protect you against the penalties. So in terms of documentation, it's always good to consolidate and make sure that you have And then some of the key points here is, you characterize your entity correctly. Particularly, when we covered the IT services, make sure that there's a contract in place if it's on a contract basis. Make sure you have comparables that are appropriate and they're obviously comparable. The database, and there are very many databases out there, but select one that has a very good global reach. Some of the databases out there focus on a particular region. You need a database that has Asia Pacific, or obviously a lot of Indian companies. And if there's any adjustments that you need to make sure that's done correctly. And then in terms of the Tipi approach, on these other items is, make sure that you, select a tested party, and whether you do a 3-year average or a 5-year average, and then you select the correct methodology and whether it's on a transactional basis or on a profit basis, and document all the things such as the profit level indicator and how you came about the comparables. With that, we will cover now, turn it back to Chris on BEPS and how it has affected India.
Yeah, just given the timing, I think we're going to give this short shrift. Just a couple of points. Again, my background is broader than Darren and Sunil's, where I'm looking more at kind of the totality of the international tax reporting and planning from a U.S. perspective. Some of the things, as I serve what are typically middle market companies, that I'd like to talk about at this point in lieu of the BEPS, what I see middle market companies doing is taking a tactical approach to their transfer pricing. And it'll be reactive. They'll say, okay, I have to have transfer pricing in Mexico. Let me just do it for Mexico. I have to have transfer pricing in India, so let me just do it for India. And these days, that's not your best approach. Really, as a U.S. headquartered business, step back. Think about what you want your business to be doing and how best to get that done. And let your business drive the transfer pricing. Get in front of it, be systematic about it. And to be honest, in these tactical approaches, what I've seen is it's largely driven by the subsidiary in the other jurisdiction. Their recommendations are usually that the margins are going to be high to mitigate the risk in the local jurisdiction. In a U.S. tech company, that means you may be overpaying or having excess profits in that local jurisdiction while you're running a loss in the United States. And so drive the transfer pricing from your headquarters, because that's the best place to do it, where you have full visibility excuse me, on the operations of the business and what your business needs are going to be. So with that, I think we're basically out of time. So I'm going to turn it over to Emily to wrap this up. So I do want to thank our presenters. You both did a great job. Really appreciate the work on the slide decks. Sunil, it's like the middle of the night there in India, so thank you for being up late. Darren, I really appreciate your input. And Emily, I'm going to turn it over to you to wrap this up.
Great. Thank you, Chris. And thank you, Darren and Sunil, for a great presentation today. We certainly covered a lot of material. I see we had a couple of attendee questions come in, and unfortunately we're out of time, but I will pass those on to the speakers, and we will be following up with you after the webcast. I want to thank everyone for joining us today. And I'm going to push a webcast survey. If you have time to fill this out, we would greatly appreciate it. We value your feedback. And thank you all again, and we hope you'll join us again next time.
All right. Thanks, everyone. Bye.
Thank you, everyone. Bye-bye. Take care. Have a good day. Bye.